Market Monitor. Again, to those of you new or who participated in the weekly call we did previously, we are trying to do a deeper dive, but pretty much the same content. We'll do a quick economic review, maybe a bit of a market update, and speak about relevant topics of the day. But additionally, this will replace the Monday market call that we had at 3:30 every Monday, and we're going to replace it with a Wednesday. Second Wednesday of the month going forward on a monthly basis, and we'll rotate relevant issues. But ultimately, this will be the new format for the Monday Market Monitor, excuse me. And we're calling it the Monthly Market Monitor. So those of you who like acronyms, you can keep the same ones. But again, starting with the same kind of content, I'd like to get into some economic releases we had over the past several weeks, and kind of give you a rundown of what the outlook is from an investment perspective, from an economic perspective. As the COVID lockdowns are lifted and we go back to full employment, hopefully sometime soon, how it will affect your credit union, your margins, and the rest of it. So that's kind of the goal of what we're doing here today. So we'll go ahead and jump into a couple of the latest releases. First, here is the unemployment rate, and again, it's still teetering a little above 6%. And what's noteworthy about this, in my opinion, is that it's starting to flatten out a little bit. You can see the major slope down towards 6% from the peak of north of 15%, and going back to 2012 up to 2014. It took 2 years plus for it to drop 2 percentage points. And you can see how quickly this has dropped off a lot. But again, from the pandemic and the immediate seizure of a lot of the parts of the economy, closing restaurants, etc., had a very major effect on unemployment, obviously. And the feds did a lot of stimulus with federal matching public assistance for people out of work, against small businesses. Who's eligible for the first couple of rounds of COVID relief went to small businesses in some cases. You can see now that it's quickly rebounded, but still starting to level off. And the trick now is to estimate how long it'll take for it to get down back to 5-ish%, which the Fed traditionally called full employment. It ranged between 4, 4.5, and 5. They'll probably up the ante as to what full employment means, and they signal that through their minutes at the Fed, and what they kind of view in their mind as full employment. But we're still a ways from there. But the unemployment rate, again, is still north of 6%. Initial jobless claims, again, this is one that has showed pretty strong improvement going back to June. And the yellow line there is a 4-week moving average. And the latest number came out at 770,000, which, again, is an improvement from the really bad numbers we had back in the months after the beginning of the pandemic. But 746,000 is an improvement, but it's certainly not. It's not quite time to get out the high fives and do cheerleading, because we still have a long way to go. This is a little longer period of time, going back over 5 years, as to the unemployment or the initial jobless claims numbers, with a more of a historical feature. And again, you can see how immediate and exacerbated the initial jobless claims were at the start of the pandemic, and how quickly they snap back again. But again, the same flattening effect here that we see in the unemployment rate. It has been steady around 770,000, again, which is an improvement, but it's certainly not anywhere near where we were pre-pandemic. And again, going back this period up until the late part of February 2020, the range bound between 201 and 299,000. So where I'm from in northern Wisconsin, that's 250,000 average over that period of time, about 5 years. So it certainly shows where we were, where we are, and where we're going. And we're still triple the initial jobless claims quote run rate of a strong, fully employed economy. So we have a ways to go before we get down to where we think from a labor perspective that we're beyond this correction and this pandemic. Continuing jobless claims also, you can see the very strong, very similar trends here, very, very strong continuing claims. And it's dropped off precipitously, but still well above the runway we have going back to the previous few years. And this also is beginning to flatten out. And again, this is a trend that we want to see erased. But with a lot of the federal assistance and all the money, the trillions and trillions of money thrown at providing relief for people out of work, there is work available as we start to open the economy up again. But again, people are doing the math in their head as to whether or not it's worth working when public assistance is so high relative to what it was pre-pandemic. Again, we know that people are hurting and not having able employment, but as we grow and we reopen our economy, there will be jobs available, but you might have to pay up to get people to come back to work and not take public assistance. This is what I talk about with job vacancies. It's about the level it was in 2018 or so. Range bound, it was really, really strong. In the months, I guess the 2 years leading up to the pandemic, range bound between 7 and 7.5 million. And now we're approaching that $7 million benchmark again, which certainly shows that there is ample work available. But again, like we've talked about in the past, if people listen to the call, this particular correction in the pandemic really affected low-income people most. And when I speak of that, it's the bellhops at the hotels, it's waitresses, wait staff, dishwashers at restaurants, etc. People who work for tips. Again, with the pandemic being closed and the 25% restriction imposed in many places in the Northeast and California, it's certainly going to have a very, very strong feedback loop as to unemployment claims and really hurting low reportable income. Again, with tips, they make a pretty decent living if you work at a good restaurant in the Northeast or in California. So it's certainly indicative of the pain we have to shed from getting the economy open up again. Retail sales were down a little bit in February. This new number is coming out this Friday. Actually tomorrow, the 15th, excuse me. So keep a sharp eye on this. This might be a little bit dated. You can see at the start of the shutdown going back to March and February of last year, how much it affected retail sales. And again, this is all the stimulus funding, hoarding. If you recall the long lines, the toilet paper run, everybody, there's no stock in any of the big box retail stores. I remember driving to work, going by Costco, and they open up the store early for elderly and people most at risk from COVID exposure. And there was a line wrapped around the parking lot at 8 o'clock in the morning for a 9 o'clock open at Costco. So this is back at that period of time. And what's noteworthy here is the shutdown and the hoarding and stimulus months. If you kind of just eyeball it and wash it out, they pretty much eliminate themselves. So there was a big supply chain bottleneck there. Again, don't forget about some of the butcher shops, in North Dakota, etc., on providing ground beef that were shut down because there were COVID outbreaks. So there was a lot of panic buying at the time. More recently, this is being cited as the spike in retail sales in January, the $600 stimulus. And I keep a sharp eye on the number tomorrow because that's going to be indicative of the latest round of stimulus that was placed in the latest round of COVID relief. And we're going to see the rebound sales jump again. They're expected to be up 5 to 6%. So keep a sharp eye on that one tomorrow, and tell your friends to know that John mentioned to watch out for that tomorrow, because that might be a market mover. Maybe it won't be, but expected to be 5-6% plus. Here's kind of a synopsis of sectors we track typically with retail sales. Motor vehicle sales, you can see the year over year and the month over month seasonally adjusted numbers, up 12% in motor vehicle sales. But what's noteworthy, electronics and appliances, but restaurants and etc., 21% down year over year. So that is a pretty major negative trend as it is. And the strongest thing that's up year over year, and almost 30% in some cases, 27.2, is this non-store metric here. And again, we can all estimate what that is. It is direct selling, telemarketing, online retailing. That, of course, very happy guy there is Jeff Bezos, CEO of Amazon. Again, talk about perfect timing for a business model. He bought that Whole Foods and had grocery delivery. So people who kind of fast forwarded their buying habits, kind of got it forced on them back in March of last year, and even going anywhere. So that sit at home convenience to retail delivery, that's a channel that he had all the capacity in, the personnel, the supply chain is already there. So he certainly took advantage of the market opportunity. It's just a matter of determining whether or not these mom and pop shops come back at all or not. Because even before the big rush to home delivery, Walmart and Home Depot and all the big ones were threatening to take out every town in Wisconsin with 8,000 or 10,000 people. The hardware store is gone, the flower shop is gone. There's just a big box retail store, and this now is exacerbating it with delivery and big box, really hurting small businesses in a lot of small towns across America. This is interesting too. Government transfer payments as a percent of total income. You can see that the little highlighted segment there, October to January. High percentage of transfer payments as related to total income, 20-25% in some cases. So again, this is stimulus grants and unusual exacerbated payments out. And again, there's a federal $300 a week or something matching funds where there wasn't any federal assistance for unemployment. Is always a state program. So in conjunction with state and federal, this is all included in this particular metric. Personal savings rate. Again, a lot of you credit unions have probably seen this on your own balance sheet with the high deposit rates you're seeing. And again, this is very traceable to previous pandemics and previous crises, although not nearly as exacerbated. Even back in 08 and 09, when people get scared, they save money. It's a dysfunctional kind of a situation. So it's no difference this time. The big spike in savings again, and then a precipitous drop off. But again, we've seen a rebound. And a lot of economists are citing that maybe the stimulus funds are done because they're going straight into savings accounts of people. So at least what they did at the last round is they lowered the income cap, income down to people eligible for stimulus payments. Again, because you'll pay, maybe some pass-through rent or buy groceries with it. We'll see how the numbers play out over the next couple of months, but there's the impetus behind cutting the income cap for that particular second round of stimulus eligibility. Again, personal income excluding government transfer payments declined by $23 billion almost in January 2021. So, again, very small number there on the January metric, but you can see the trend analysis and the big drop off at the start of the pandemic. Again, this is excluding government handouts month over month. So on the retail sales side and personal income side, it's certainly exacerbated. It's just a matter of whether or not we're going to get out of this again with strong employment growth going forward, and whether or not people take the job opportunities that are there or continue to take public assistance. It's going to be it's curious times that we're going to face here in 2021. Shifting gears a bit to the housing sector, you can see housing starts are on the downtrend. And this is a bit alarming to, I think, the Federal Reserve Bank and some of the macroeconomists, because housing really does drive a lot of GDP growth, a lot of drywallers and plumbers and et cetera out there and building new housing. But certainly it's down again. And what they're pairing that to is perhaps the run up in 10-year yields we've seen over the last several months, if that's a causal factor or not. There are also a lot of other things involved as well, but this is a number that the people who watch the economy closely are hoping to see rebound. Existing home sales, again, if you eliminate the big correction we saw, February to looks like about April, it's almost on the same trend line that it was pre-pandemic. So this might, level off, maybe get back to 6.5 million annually. But this is a number that's trending down as well. They're blaming the polar vortex. Most of this data is old, about a month or so it hasn't been 50 degrees, for a while. It was a really cold February and a lot of rain, so they might blame that on that particular thing. But still, macroeconomists want to see this do a little bit better in the spring and summer as we go on forward. So GDP growth, I thought this was interesting too. Going back to 2018, you can see 3% growth. And again, everybody can see where the pandemic started. But what I want you to be cognizant of is that the outlook going forward, is now that we're a full year. It was last March when all the lockdowns started, and here we are, April of 2021. So a full year into the pandemic. So if you see GDP growth, really strong GDP growth of 5, 6, 7%, which is certainly possible, just couch your expectations that is a year-over-year metric. And 1 year ago now was pretty terrible. So having a 5% growth over a very low bogey is nothing to write home about. You really need to kind of see more of a longer trend line as to how it relates perhaps to 2019 measures, not 2020 measures. And you can see here's the 10-year run rate going back to 2012. And you can see a big precipitous annual growth change from the pandemic. So we're still down negative 2%, but that is going to snap back really, really vigorously, even if we hardly get any more job growth than what we have currently. This is the forecast from the Federal Reserve. You can see the GDP growth forecast is upwards of 5 to almost 6%. I saw the interview with Chair Powell on 60 Minutes this weekend, and he talked about he wouldn't be surprised to see 6 or 7% GDP annualized growth during 2021. And again, he signaled the Fed's outlook now, again, is the average, of the growth. So if they see a 6, 7% rate increase, it doesn't mean they're going to raise rates because they want to let it run hot. They said, so to speak. So the average on 2% inflation metric. So you'll consider, the slack that is represented from 2021 looking very strong. He's going to couch that based on the year-over-year anomaly that we talked about earlier. The inflation rate you can see is north of 1.5% and trending towards 2%, but 2% is what the Fed has signaled as their bogey, to average 2% before they consider raising rates. And one thing they mentioned today, I read the Wall Street Journal today, is that the Fed is signaling kind of their outlook and their framework out to at least all of 2022 before they precipitously raise rates. And he did signal today that they will winnow down the QE portfolio, meaning that they'll buy less in QE and taper the bond purchases before they raise rates. So it's another way of saying, one thing will signal the next. So the first move of the Fed will be to see them taper their purchases either with treasuries or mortgage backs, which currently is $80 billion a month in treasuries and $40 billion a month in mortgage backs. And they may even change the composition of that purchase before they winnow and taper it down. But again, what they're signaling, it's at least through 2022, at least if you believe their outlook and their press conferences, that's what they're signaling to the marketplace. Another thing they talked about a lot was transitionary inflation. And again, this is the headline longer run forecast. And you see the dot above the 2% benchmark. They're calling that transitionary. And they're signaling to the market as well that they're going to allow, inflation to run north of 2 for some period of time because the supply chains and all the bottlenecks in production and transportation, they're going to have, a run up in goods because all this money is on the sidelines and they're going to buy a limited number of goods. And again, so much inventory, almost supply chain, only so fast you can replace the inventory. So naturally prices will go up. And they're saying it's going to be a short run phenomenon only. Hopefully they're right because, if we can see a strong run up in inflation, it might just continue. I hope not to see, the late 70s, early 80s again. We have the, stagflation and high rates, but the risk is certainly inherent with all the liquidity in the market right now and strong job growth, probably paramount and going to happen in 2021. It could certainly exacerbate this outlook. Shifting gears to the securities market and the yield curve. This is through the end of the quarter, this particular one. So February to end of February to end of March 2021, you can see the run up in yields. 10-year yields are up 33 basis points, and the short end of the curve has hardly moved at all. The 2-year Treasury, again, at 16%, 16 basis points, is hardly much of a premium above cash. And again, the Fed's paying 10 basis points on cash at the Federal Reserve, interest on reserves. So to take a term risk to only earn 6 above cash, it's a bit of a stall out for a lot of money market funds and people who invest short-term funds, that it isn't worth the return to take term risk for only a 6 basis point reward. This is a year-over-year number. You can see how 1% north the 10-year bill has rallied since the start of the pandemic. So again, we had a really fast cut in rates. They cut rates by 1% and had even intra-meeting rate reductions on the Fed funds rate. So this shows the year-over-year difference, in the big run-up, and how the market is almost expecting to snap back to where it was pre-pandemic. But again, we had the legacy expenses and a higher unemployment rate this time around. So it's going to be curious how we proceed. This is what I talked about earlier, the 2-year Treasury yield on a 3-year horizon, 16 basis points, and it's been range bound in that area for several weeks and months now. 10-year Treasury yield, we had a little longer, a faster run up here. And again, with the inflation risk that's inherent in the market with all the stimulus, this is part of the reason that 10-year Treasuries are up. And again, the Fed did signal they want to get some more slope in the curve, meaning that investors are rewarded a little bit for extending because they're too hesitant to extend out and provide any long-term funding because they're afraid of interest rate risk, and the examiners come in and yell at them and all this and how you got this managed. So they're reluctant to do that, but with the slope of the curve increasing like it has, it looks like perhaps a lot of people taking advantage of it and extended out 10-year part of the curve. This is the rate hike path expectations. You can see 4 hikes starting, in December of 2022, so the end of 2022 through 2024. So this is the path of rate hikes that they're estimating this particular cycle. We'll see if it comes to fruition or not. If they're forced to raise sooner than that, it's going to be curious how they play this and the particular benchmarks they target on the curve for purchase. If there's an anomaly and a higher slope than they want between 2 and 3 years, or between 5 and 10 years, or whatever the particular part of the curve that they want to address. This is another risk that I see inherent out there. Now that the 10-year yields, are getting 1.5% and north, a lot of these traditional fixed income investors are buying blue chip dividend paying stocks because dividends pay a higher yield than your typical 7 or 10-year Treasury. That has now crossed over again. You've maybe seen something on the news about the tech companies, because generally they don't pay dividends at tech companies. Some of them do, but they're going to rebalance their portfolios and sell off speculative stocks and just lock in their 1.5 or 2 or 1.75% dividend yield on a fixed income instrument, which is so-called risk-free, which is again the Treasury benchmark. But it's entirely possible that they rebalance here. But again, what we've seen so far is stock market again a record high, NASDAQ are record highs, even though they've walked back a little bit the last few weeks. S&P 500 is as high as it's been, so the outlook is pretty strong for the blue chips in the stock market and the NASDAQ. But if the 10-year continues to go up, it might certainly burst some of the bubble inherent in those markets that some economists estimate are there. This is SOFR. So if anyone wants to ask a trivia question, go with Aaron Rodgers on Jeopardy one night. It means secured overnight financing rate. So I have the definition in here, but it's a broad measure, again, of borrowing overnight cash and using government securities as collateral. So that's what they're trying to use to replace LIBOR, a so-called the floating rate indexes, because again, LIBOR, there was some collusion on understating the true borrowing costs at the 2008-2009 crisis, and it took them 8 or 10 years to work out a replacement index, and now they're trying to show the market that this is it. SOFR is the new index that you can trust because no shenanigans can go on. It's a transaction-based index. Well, you can see how this has gone, going back to the early part of 2019. What's noteworthy here, again, is the month-end and quarter-end spikes in yields in this particular rate, again, because it's transaction-based. So every financial institution, they do window dressing type of trades at month-end and quarter-end to present whatever it is to their shareholders or whatever it is to their boards. And you can see all along February, March, April, May, 8 or 10 or 15 basis point spikes And in one particular month, there was a couple percentage point spikes in overnight investment rates, offered by the Fed. So the Fed came in and threw a bunch of liquidity at the overnight repo market, and pretty much smoothed out those operations to the point where now SOFR is actually trading at 1 basis point. So, and it's been range bound now, it looks like going back for almost a year, but 1 basis point has been for several months now. And again, cash at the Federal Reserve Bank is 10 basis points. And most benchmark SOFR debentures I see from agencies 3 to 4 years are SOFR plus 4, SOFR plus 3. So it's difficult for investors to take an investment on a floating rate that yields less than cash, because after all, cash is floating rate too, right? So why take any term risk, any spread widening risk at all? So this is very difficult for investors to swallow, this index being so low. And they're hoping to get it up sometime soon to a level where it pays more than cash to take any term investment on balance sheet. And interest on excess reserves. This is again going back to 2018. This is what you get paid on reserves at the Federal Reserve Bank. So it's been 10 basis points for about a year now since the start of the pandemic. And again, the SOFR index is a number that's below that, 1 basis point. And this is a spread going back to when the Fed first announced that 10 basis points is the rate they're going to pay on cash on reserves. And you can see that the mean is about 3 basis points, but it's 9 basis points below where it should trade. So what I'm curious about is, what is that little Goldilocks zone on SOFR versus the target rate on cash? I know Fed funds effective has been traditionally the rate that they look to, and that's been about 7 basis points now. So again, that's below the 10 basis point benchmark. But if SOFR is supposed to be the index that we're all looking towards to be the new, best generation index, then perhaps they raise the reserve rate, and they signaled that they're open to this option, raising the reserve rate and not calling it raising the interest rates. Because again, money market funds, like we talked about before, 2-year treasury yields are 16 or something like that. And generally, money market funds have an average life of 6 months, 9 months or less. So that's right in their wheelhouse of investments they buy. But after you pay all your CFAs and your accounting people, there's no margin on anything to buy. So you might as well just stay in cash. So having this index so low is really killing the money market industry. And again, they go back to that with the break the buck, where they can't break the dollar price on a money market index fund if you get government index fund. So effectively, there are no investment options whatsoever other than cash, given the benchmark so low. So does this mean that they're going to start using SOFR as the new Fed funds index? I don't know. It's difficult to show, and they actually punted. They're supposed to start publishing term SOFR, meaning 1 month SOFR, meaning 3 months SOFR, as a debenture to start to replace a LIBOR, but they punted till the end of 2021 before publishing it. So investors like me, who rely on funding floating rate assets most of the time, it's difficult for us to get comfortable with the index when there's no debenture, there's no term number, and there's no market to kind of get comfortable with as this deadline approaches, with LIBOR going away in June of 2023. So I just want to get used to an index and understand how it trades relative to other things, and to recognize anomalies of when it is to invest things. So this is a big problem for the Fed if they want to make this SOFR index, the new go-to index for the industry. Here's a 30-year Fannie commitment rates, 2.5%. So we're seeing 30-year conforming mortgages now around 3. Generally, it's 50 to 60 basis points spread above this as to what the street offers on conforming mortgages. Again, that's the margin you make on selling off to Fannie, and your servicing expense and all the rest is embedded in there. The MBA refinance index is down pretty sharply from the highs, and again, they're blaming the 10-year treasury yield being up as kind of slowing down this refinance index. But again, the rates have been low for about a year now, so maybe people who can refinance have already done it, But again, it wasn't really actionable for a lot of people during the pandemic because, you know, these places are closed and some folks aren't comfortable doing stuff online or with DocuSign or whatever else or through Zoom. So maybe there's opportunity here as banks and credit unions open up again to finance more mortgages. Maybe this rebounds, but certainly this downward trend is a sign that maybe it won't. These are some investment options. Again, these are just some callable offers in the street. These yellow ones are newer, and again, they settle earlier, you know, this month. But you know, your 3-year paper, 50 basis points like this particular one, 6-month lockout with a quarterly call feature. So even a 6-year, you know, 150 with a 3-month quarterly option. So you're getting paid quite a bit to take higher term risk, but again, keep an eye on this duration before the call option begins. It's only a 3-month lockout. So with quarterly options, I mean, that's 23 potential call options over the life of this particular investment. So it pays for the agencies to issue this. It doesn't always pay to buy it. So just be cognizant of the option risk you're taking on when you buy a callable investment. This is a newer production, 15-year mortgage back, kind of an idea of where to expect. This is actually got a little worse today. I did this yesterday. So 101 and 3, 101 and 5 is probably your dollar price on this particular one. So you're in the 120 range, give or take, for about a 5-year average life. And what I like to make sure people are noteworthy is down here. This number 30, 14, 15, 18. This is spread to the like-term interpolated treasury curve. So in other words, 6.2-year treasury, this is 14 over if this bond pays at this speed, 109 PSA. And again, these are all assumptions. What you see here is not what will happen with this bond over the life, but it gives you a kind of a thumbnail sketch as to what to expect about given these prepay assumptions. And again, this is a straight line assumption. Every month it'll be the same, and again, they change. So again, even a super fast PSA 1600 is pretty fast. 75 bips, which in this case is 60 over the curve. But with a coupon of 1.5, it's not likely to pay that fast. But again, this gives you an idea of the benchmarks for 15-year paper. 30-year paper, again, we're north of par on 2% coupon. So again, here, the 40 over the curve. And it wasn't long ago, this was 1% over the curve. But again, the spreads were really, really, really wide at that point in time because the 10-year yields were so low. With the run-up in 10-year yields, spreads have tightened, yes, but still you're about 2%, almost 2% yield for 8.5-year average life, and again 40 over the curve. And this is kind of your same debentures to keep an eye on. And generally the up 300, up 200, the slow speeds are what a lot of people forecast this to pay. To extend up to 10 years. So 10-year average life at 193 is something you might own a long, long time if 10-year treasury yields do continue to run up. You wouldn't see much extension in these. You see a lot of extension in these, excuse me, and not much yield pickup because the premium is pretty low. That's all I have for today's call. I'm going to see if there's any questions out there. Okay, I forgot to mention at the top, excuse me, is questions and answers in your keyboard. You can enter if you wish. I see none here. I'll open it up to the audience if anybody has any questions out there. Julie, you can unmute the participants. Okay, looks like that's a wrap. In about half an hour for our inaugural monthly market monitor. Thank you all for dialing in. Again, generally the second Wednesday of every month at 3:30 is when we're penciling in this in every month. So please stay tuned and attend again. Thank you all for calling.